earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
So good morning and welcome to the School of Cash Flow podcast. I'm the host, Dale Corpus. Hey, we're in for a treat for today. I have my first expert in the industrial sector of commercial real estate. It's an asset class that's not as frequently talked about compared to something like multifamily. And even for me, it's a foreign concept. So people are typically intimidated initially when they think about, industrial assets and triple net leases. My guest, Mr. Neil Wahlgren, today is going to break it down for us. Here's a little bit more info about my guest today. So Mr. Wahlgren brings 10 years of direct real estate experience as both an investor and capital markets expert at MAG Capital Partners, having raised equity for over $450 million in real estate and operating companies. Prior to joining MAG Capital Partners, Mr. Wahlgren led a Bay Area real estate investment firm for 4 years, growing all aspects of the business to an asset under management exceeding $500 million. Mr. Wahlgren began his career as a military officer, logged over 2,500 flight hours piloting the C-130 in the Air Force and Navy. Following combat tours to Iraq and Afghanistan, he concluded his military career as a lieutenant commander. And so now Mr. Wahlgren resides with his wife and son in San Francisco and holds a BS from the U.S. Air Force Academy and an MBA from Texas A&M University. So without further ado, welcome to the show, Neil. How are you?
I'm doing great, Dale. I appreciate you having me on.
Yeah, it's like, so you, I know you're based in the, in the Bay Area. Obviously, everybody like my audience knows I'm in the East Bay in San Ramon. And I was just chatting with you right before this, and it's like I didn't realize that you were initially from San Ramon. I've been here for like 15 years now, so you've seen it way before I knew all about it now. You know what I mean? It was a lot different back then.
Yeah. The East Bay out there was not even officially part of the Bay Area when I was living there. There was about 15 miles of ranch land separating, what we considered the Bay Area back then from the, kind of distant suburbs. But now it's all, one giant metro.
That's crazy, but you're still in the Bay, and then we kind of flip flop because you're in San Francisco and I grew up out over there. Yeah,
absolutely.
So going back to your bio, can you tell me a little bit more about yourself? Perhaps adding a little color to it. Tell me more, and also what your main focus is right now.
Yeah, absolutely. So like you mentioned, NorCal native. Grew up out there, but actually lived out of state for about 15 years. I lived in Japan for about 4, a couple of years overseas in the Middle East, Arkansas, Texas, Oklahoma, Arizona, Colorado. I mean, just all over the U.S., through a lot of the military and flying, kind of stations and deployments out there. So kind of a neat way to see the world and great way to kind of cut your teeth in your 20s. And, for me, it kind of set up really what I needed was just a really, strong foundation of kind of discipline and structure and, really coming from the upbringing I had that was really, the right place at the right time. And, had a great experience with that. But while I was kind of getting near the end, I started going, all right, do I stay in the military? Do I, do what most pilots do and go to the commercial airlines, or do I do something different? And in that period, I had actually met a couple of reserve pilots who were actually fairly into real estate investing. They were buying, single family homes, and they were still flying, but they were kind of almost more excited to talk about these real estate deals they were doing out of state. Some of them they had never seen before, which is wild to me, Yeah. And after a while, I jumped in there and I bought a couple of small single family, basically turnkey rental homes in Indiana. And it really, it whet my appetite for this idea that, hey, you can put your money to work and have, really start this residual cash flow that requires nothing from your day to day. And, suddenly you're like, all right, I'm only getting a few $100 right now, but what if I bought another one or bought 5 more or bought 10 more, and this idea of, hey, I could scale this in a pretty clear path to eventually, offset or even, fully eliminate the need for, a 9 to 5. And that was, ultimately what prompted my full-time move into the real estate world about 7 years ago.
Okay. No, that's really interesting. So you started off with residential. Do you still own a lot of that same residential, or did you sell it all off?
I've sold off a bunch of it, just took some profits, probably a year too early, but
Yeah.
is what it is.
Yeah.
But yeah, it was actually led me into, an opportunity in the Bay Area where before Mad Capital, I was working for a firm that we were, effectively investor equity focused, and we would partner with actually commercial operators, and kind of did a transition over to commercial real estate. Same fundamentals, just larger scale, and what I viewed to be a more manageable, controllable risk with still similar or if not better returns, and that was ultimately what flowed into that.
Okay, I got it. So you're in the industrial space. Okay, just can you even break that down? What does that even mean? What is it like? What are the categories of it?
Sure. So just, industrial 101, it's an interesting asset class because the majority of people will probably never even walk into an industrial warehouse in their life. It's kind of a foreign concept. It's big, they're boring buildings, four walls and a roof or some combination of large square footage buildings. And, really the 3 main categories you're going to have, warehouse / manufacturing. And that's going to be those, just large square footage, typically, 50 to 250,000 square feet, high bay, typically 40-foot ceilings. You can have, shipping and receiving bays for trucks. And ultimately it will be either storage, it'll be distribution, or it'll be manufacturing, and some flexible use inside on how companies want to use that. So that's the first. The second is going to be flex industrial, and that's going to be more similar to a multi-tenant retail center. So imagine long buildings, kind of subdivided into smaller square foot sections. Each one might be 1,000 to 3,000 square feet. They typically will still have a truck bay for, shipping and receiving, but it'll be everything from like tire shops to storage facilities for, say, a lawn care business to, the small manufacturing for a craft business, just something that maybe is not customer or retail focused. It's sort of the behind the scenes, either storage or manufacturing for smaller, typically mom and pop, what we call microcredit businesses or microcredit tenants. And then the third is going to be specialty industrial. And that's going to range really, kind of custom specific build real estate for a very particular use. And that could be cold storage. That could be, petrochemicals. Imagine like smokestacks or concrete yards, or even like pharmaceuticals, biotech, with, pressurized and temperature controlled rooms. I mean, all these are going to be specialty industrial that are going to be kind of its own asset class there.
Oh, interesting. Over at your current company, do you focus on a certain ones, or do you focus? Do you work with all of them?
We so at Mad Capital, who I'm a principal with, we focus almost exclusively on light manufacturing, tenanted industrial.
Okay, what are the biggest risks in an asset like that?
Yeah, so I mean, a lot of it comes down to, especially from a comparison basis to, say, multifamily, you have a more concentrated risk in that you almost always have a single tenant in these buildings. So that the building is going to be occupied by a much larger, more stabilized tenant. However, the risk from an occupancy standpoint is going to be more binary than a multifamily. So when you go into multifamily, you're going to always expect a certain amount of vacancy, right? Yeah. You might come in and go, all right, I'm going to buy this building. I'm going to do some improvements. I think I'll be able to increase the rents. I think I'll be able to increase the occupancy and, basically run this at a high aggregate level of occupancy. On the flip side, Industrial, especially when you come in buying a occupied building, it's a much more of a defensive play. So you have full occupancy. Usually your lease will have built-in rent bumps, and you're going to have long-term leases. So, for us, we're typically putting new leases on the buildings we buy. 20-year terms is the norm. So, very long-term leases. Usually the tenant has been in place for sometimes 30, 40, 50 years. So they are very much tied to that real estate as they are with their operations. And those two are kind of, intertwined in a great way. It makes that tenant super sticky. And, as an investor, we are largely looking at, real estate fundamentals paired with how strong is the credit behind our tenant. How certain are we that tenant's going to be able to stay in business and pay their rent?
Okay. So I don't understand, I understand multifamily, but because you're dealing with, again, you're dealing with, tenants, and you're leasing to companies and all that kind of stuff. But so on the multifamily side, obviously I'm familiar with the value add so that you can increase rents and then eventually increase the value. These are, like you said, you said 20-year leases or whatnot, with incremental bumps potentially annually. Is that where the value is coming in because you're building in the rent bumps, or is it something else?
Yeah. So the value add component is going to be less on an industrial building. Typically you start with a higher amount of cash flow from day one in industrial than you would in multifamily. Mm-hmm. However, the amount of value you're adding is more contractual in nature rather than physical improvements. And so to take that a step further, really one of the unique advantages of the single tenant industrial space is the leases tend to be absolute triple net. So just a quick review, in comparison to multifamily, where if you own an apartment building, you're probably paying your own property taxes. You're almost certainly paying your own property insurance. You're going to be paying probably some combination or some part of the utilities and almost all of the building maintenance. Conversely, in a triple net lease structure, in an industrial setup, the tenant pays for all that. They pay their own property tax, they pay their own insurance, they pay their own utilities, and most of all, they pay their own building maintenance. So on a 20-year lease, that roof's going to need replacing in 10 years. The tenant pays for it. The HVAC has a 12-year service life. The tenant's going to pay for it. Even pavement repairs, new paint. Literally, it's as if they own the building from an expense standpoint, but we own the building and they are renters, paying us reliable rent with that expense line removed out of our underwriting pro forma.
Is there a property manager involved, or are they their own property manager? I'm talking about the tenant. Yeah.
It's essentially self-managed. So, we will send an inspector in, every 2 or 3 years just to kind of take a look at it. We'll identify, hey, maybe this repair needs to be done, but the tenant is contractually required to both do the repair and pay for it.
It's just really interesting to hear that, because a lot of the headaches in multifamily is just from all of the maintenance and all the calls and dealing with that. Yeah. It's just, to be honest with you, I'm not even kidding you. It just sounds so foreign to me that that type of stuff doesn't exist in this with what you're talking about. I have to wrap my head around it.
Yeah, the triple net side, it really, we call them sleep easy investments because. Don't get me wrong, surprises happen, but they're not our surprises, right? They're our tenant surprises when unexpected repairs come up. So, bathroom stops up, I don't get a call. They handle it themselves. So that's kind of the joy and the advantage of a triple net lease structure as a landlord.
So, I'm just doing the analogy to multifamily because I understand it. So when you have an applicant that wants to be a tenant, you run their credit report and do a background check and then you see if they have any criminal activity. What is there an equivalent on your side when you're doing a check on a tenant and whatnot? What kinds of things, how do you check on a company's credit and whatnot? Is there a special scoring system, or how does it work over there?
Yeah, no, great questions. So, in general, you can divide tenants into public credit and private credit. So public credit, would be, say you have an Amazon as your tenant, right? Their financials are very public. They have underwriters, they have Moody's and S&P will give them a very objective kind of credit rating. So you know with a high degree of certainty kind of what their credit worthiness is. Conversely, you have privately held companies, and that's the majority of what we buy have privately held tenants. And we go in, and it's a little harder to figure out what their financials are. But when something's a little more difficult, that also creates opportunity. So we've built up in my opinion, a very strong internal credit department. So we have three effectively business credit underwriters who, when we go in on every potential deal, they are building out typically like a 15 to 20 page, what we call a credit memo. And that's, looking at audited financial statements. That's looking at, if sometimes they sell us the building and lease it back. If that happens, how are they using the cash from that sale? And then we work with their management to kind of build out a forward-looking projection that will benchmark, where we think their future performance will look like. And one unique thing on a single tenant model is we actually typically will get quarterly financial statements required from our tenant. So, imagine being a multifamily landlord and, telling your renters they got to give their, pay statements every 3 months. It would be unheard of. But, when you have more concentration with a single tenant, you can demand that. And so every quarter we get a full set of financial statements, balance sheet, look at their debt load. And really we're looking for trends, and we're looking, hey, how does this, kind of compare to our benchmark, growth projections, and, how certain are we that they're going to be able to continue to pay their rent?
What happens when you're looking at the financials and it doesn't, it doesn't look like it's on track where they can pay their rent? Does it causes some initial alarm? Do you guys have to do anything at that point? You just kind of wait it out to see how things progress?
Yeah. Well, before I answer that, I will say your typical tenant profile is going to be much, much, much stronger than what you might find in, a retail tenant, or especially a multifamily tenant, right? So these companies, just to paint a picture, our average company profile, it's been in business 70, 80 years. Most of them do close to 100 million a year in revenues. So these are very established companies that are filling a large amount of square footage. And because of that, they typically run themselves in a professional manner. They keep reserves. They've shown the, historical ability to weather recessionary storms. Most of them have probably seen a dozen recessions and made it through. So that's kind of where we start from. But then to your point, we watch the ongoing credit history after we buy, and we watch the ebb and flow. And typically, what our MO is as an investment group is, if we saw, say, 3 or 4 declining quarters, and maybe the credit scenario has shifted to a point where now this is, not as compelling of a credit play as what we might have wanted. By requiring those quarterly statements early, we can be proactive. Our move, to be honest, is simply to sell early. So we'll typically, maybe give up some back end profits, but if we can sell early, usually at a level where we can absolutely return capital, maybe have a little bit of profits, generated through the hold period there, and ultimately redeploy to a different project. And that's, you live to fight another day. You protect investor capital. That should always be your number one, priority as an investment sponsor. And then, as long as you do that, you'll have, successful investment relationships that will follow you from deal to deal.
Makes sense. What from that capital, what's a typical deal look like? Can we talk about that?
Yeah, absolutely. So, our sweet spot, bread and butter, is going to be light manufacturing, B2B focused industrial tenants. And usually what happens is it's family owned. They've been around 50, 60 years. Either the founder or the founder's children run it. And they've recently been acquired by a private equity group. And that private equity group loves what they've seen. They're coming in, they think they can apply that private equity expertise to, exponentially continue the growth of this company. However, if that company owns its own real estate, that private equity group, they are laser focused on growing the operations. They are less interested in being real estate owners or investors. So when that happens, they'll often come straight to us, say, hey, we bought a company, came with the real estate. We want to do a sale leaseback. So they will sell us the real estate. lease it back, and then they will take the money that was tied in that real estate and basically redirect it toward the operational side, because that's how they make money.
Got it. So they're just reinvesting back into the business. They don't want to be whatever, like I'm going to say, they don't want to be property managers anymore, but the money they make, again, it'll just grow the ops, and that's what they're good at.
Exactly. Yeah. So from an operational standpoint, nothing changes. They operate, the manufacturing lines continue day to day. They just simply on paper go from an owner of that real estate to a renter of that real estate. And they, basically get a capital infusion that came from the sale of that building, and then they can redeploy it into more growth oriented parts of their business.
Going back to just, what's been happening just because of like COVID and whatnot, like how has like this space been affected, if any at all, due to COVID?
Yeah, we've been fortunate. So, one nice thing about industrial, kind of exceptionally focused in the Midwest. A lot of that's geographic. Most of our tenants ship products nationwide, everything from auto parts, aerospace parts, industrial mixers and dryers. We've got contract, white label food manufacturers. We've got white label skin and hair care manufacturers. I mean, just a number of different B2B type of industries. And they tend to be Texas to Michigan. If you could draw a straight line between the two, that's kind of our sweet spot of where we buy. And, with those, an advantage of those is they tend to be very business friendly states. So when COVID hit, I think we had 24 properties under management. 23 of them were deemed essential industries, allowed to just continue operations, never missed a beat. Most of them had some of their best years in the back half of 2020 and 2021. The only exception to that, we had a single tenant health club. They were in Iowa, forced closed. They were literally closed for, I think, 42 days, then allowed to reopen. Within 2 weeks later, they were back on, and, all being long-term gym memberships, they didn't miss a beat from a, revenue and business standpoint. So,
okay.
It was really a fortunate business class to be in, being one step away from the consumer facing side, being on that more business to business side. Yep. We find those industries tend to have a little more resiliency and are a little less affected from the day-to-day changes of the economy and, new laws and new trends that are hitting.
I heard you say that you said the Midwest. Is that the main market that you're focused on, or are you doing other deals? Are you doing deals nationwide, even outside that area?
Yeah, we're opportunistic. So, sometimes if we feel like there's, exceptional pricing, we'll buy in coastal markets. We're under contract right now, looking at a deal just outside of West Palm Beach. That deal is more enticing less so from a cash flow perspective, but more so, we feel like we're just getting great basis on the real estate. So when we feel like we're buying at a good basis, and that the market, probably from day one can support, a higher price per square foot than what we're paying, then we will pursue, non-Midwest markets, if that makes sense.
Yeah. And is that niche of the sale and the lease back, is that something that is that the main focus of what you guys do?
That is I would say a niche within a niche. So, single tenant net lease industrial is our niche, and then buying through sale leaseback is our niche within a niche, which, I like. We are hyper-focused experts in a very, small percentage of real estate transactions. However, we do it, in my opinion, probably equal or better than, all the limited players in our space.
I mean, correct me if I'm wrong, but it seems like that mitigates the risk even more so. I mean, they're getting a cash infusion
exactly.
You know what I mean? It's like to help them even pay their lease, even, for even longer term. Yeah. So that's amazing. And yeah.
One thing I really like about it too is we as an ownership group have options. Our typical horizon's about 5 years, but we're putting a 20-year lease on, right? And we're usually putting on 10-year fixed rate debt. So come year 4 or 5, let's say my tenant's in place, they're paying rent, I'm paying my investors, everyone's happy. We come to when I would sell, I'm like, I can't tell you what's going to happen in 5 years. Let's say the industrial market's sort of in the tank, right? Nobody's buying, or, you're buying at a heavy discount. we can just say, you know what, we'll just hold a few years. It's fine. We got 15 years left to lease at this point. We've got 5 years left to term on our debt. We could sit on this thing for another 5 years. And, having options like that really puts us in a, opportunistic zone of, being owners and managers of these pieces of real estate where we can really, we can read the markets and decide, when is the best time to sell and when's the best time to hold.
Okay. And then how are you guys mainly getting the leads for that type of setup? I think you mentioned private equity. Is it mainly from that, or are you guys just actively, finding another way?
Yeah, it's a mix from direct deal flow from private equity groups, largely that we've done prior business with. If they go to buy their next portfolio company, they'll often go straight to us and go, "Hey, we had a great experience. Let's do another one." They're more interested in typically moving quickly. They're not always wanting to do a, year-long mass marketing campaign. They just want to get the money out of the building, redeploy it into the business to start growing that piece fast, because that's how they make money. The other way is through, there's kind of, again, the niche level. You have commercial real estate brokers, then you have industrial brokers, and then you have industrial sale leaseback brokers. So it's a very focused subset of real estate brokers that, our founder is one of those, specialists, and we probably work with, honestly, less than 24 people nationwide in terms of, buying and selling within that category.
What worst case scenario, what would happen if the tenant goes out of business? What's the solution to that if the tenant has to leave and then, basically have an empty building?
Yeah. Well, so the other founder at MAG is a commercial real estate appraiser by trade.
Okay.
And he's really our valuation specialist. He's making sure at the end of the day, are we buying defensible real estate? So one term is helpful to know in general is called dark value. So, we're buying occupied real estate. There's a certain value of that, but you want to say, hey, if I lose a tenant, if I end up with an empty building, where is my dark value? And I want it to be pretty darn close to what I paid for it. If there's a big spread between what I'm paying for it and what it's worth empty, now I'm exposed, right? So, I want a near, what I call a near basis level dark value, very close to the basis that I have in the property. And the second is, we're looking to buy in really tight industrial markets. So the majority of what we buy in the submarkets will have typically less than 4% industrial vacancy. And a lot of that's driven, we're buying 30, 40-year-old product, and that's okay. It's 4 walls and a roof. It's not exceptionally hard to maintain, but, we're buying typically $50 to $70 a square foot, sometimes even better. New build is around $200 a square foot. So there's a very finite amount of supply of this 30 to 40-year-old product that's exceptionally less than replacement value. So for that reason, even if you're kind of out in the middle of nowhere, the demand is so high for this type of industrial product that, you're usually fairly well protected from downside risk.
Yeah, because you're basically constructing something from scratch would cost more than just buying what you guys have access to, right?
100%, yeah.
So in multifamily, a lot of people do cost segregation and whatnot for bonus depreciation. Is that something that's even applicable for these industrial types of buildings?
We love it.
Okay, I'm just checking. Yeah.
I say we're depreciation junkies. So, as much as we can get, under the current tax rules, it's 99 times out of 100 massively advantageous for our investors, for us as a sponsor team, and we can full advantage.
And I keep talking about multifamily because there's just so much information about it everywhere. Podcasts, sure. Books and whatnot. Like if people were interested in learning more or participating, about in this space, like where do they go? How would you direct them?
Yeah, we have some resources on our website on MAGCP for magcapitalpartners.com. There's some larger players in our space that are REITs. You have like Store Capital or Stag Industrial. Those are similar business model, but publicly traded REITs, and they have a lot of public disclosures and information on the space there. But those are good starting points. And of course, I always tell people, don't take someone's word at it. Just go to your network, find other investors and go, hey, who have you invested with in this space? Or do you know someone who might have? And, to me, I think referrals are always the best way to go to, get that early, at least baseline level of trust. And then you can kind of build your own due diligence and, get to know the sponsor and learn more about the space and the product that way.
I'm really just digging that sale and leaseback idea just because of, you're really mitigating that risk. But another question that just popped in my head is that since the risk is going down. And so typically in real estate, as the risk goes down, so does like your cash flow. So how does that work in the industrial space? So does what does a typical cash flow return look like on your guys' syndications then?
Yeah, I mean, it varies. And, across the board, I think we're seeing some compression in cap rates that's, kind of stifling cash flow across all commercial segments. But, in today's world, I think, even our tightest cash flow projects, typically will yield a 7.5% cash on cash from day one. Mm-hmm. Most are, 8 to 9%. And that, our model, we're able to hit that because we're fully 100% occupied. So, with that, every year, the lease will include built-in rent bumps. So we know, the cash flow is going to increase every year. There's no expense line because of the triple net lease. So cash flow comes in, we pay the mortgage, we always get a real estate loan, and then pretty much everything else flows to investors. So it's fairly high, it's consistent, and it's predictable cash flow, which is really kind of what these triple net single tenant deals are based around. And then, we'll hold 4 to 5 years, do monthly distributions, and then at the end, similar to multifamily, when we sell, we'll do return of capital, and then we'll do a profit split of all remaining proceeds.
Mm-hmm. I know another question I have is, you work with a lot of investors. Do the investors that that you work with that find you, did they come from multifamily first, and and then explore this, and and then find this, and do they kind of just migrate everything over the triple net lease type of space, or do they kind of stay in multifamily and other stuff as well? You see it all, so I'm curious.
Almost always, and I think it's human nature to kind of resist change and kind of take baby steps and invest in what you know. So, I mean, from what we see, people own a house. What makes sense for your first foray into real estate? It's a single family investment, right? I know this. I've lived in a house, right? Mm-hmm. And then the second piece might be to either actively or passively invest in multifamily. Most people have either lived in an apartment or known someone who's lived in an apartment. It's a familiar space. And then, so most of our investors will have some exposure in multifamily. And then, as they kind of grow there, they go, hey, maybe I'm kind of heavily concentrated in this asset type that tends to be value add focused. How can I maybe diversify this with a non-correlated segment of commercial real estate? And that's where, in my opinion, I think industrial is a great way to complement that. So, I mean, in myself, I have a lot of my personal funds in industrial because I know it, I'm close to it, but I complement with multifamily, and I like the two spaces. Multifamily are more risky, but have a higher upside potential with that big value add play. And, industrial, it's that, I call it as consistent mailbox money as you can have,
It's very steady.
I could tell you down to the penny what our operating account will look like even 3 years from now, I mean, just because there's no expenses. I know exactly the money coming in from the rent. I know what the mortgage looks like. I mean, that cash flow is hyper predictable. And that's, kind of a really, settling, advantageous part of, the industrial model.
Going back to the types of assets that you acquire, what's a typical price point that you go after? And how do you determine a return you would get?
Yeah. It's a great question. That we've been able to grow as a investment group, as we've brought on more investment partners and as we've, kind of grown as a team. 3 years ago, we were buying $5-6 million properties. Now I think closer to 15 to 20 is the norm. And so, with industrial, you hit kind of an upper limit roughly 15, 20 million usually correlates to about 500,000 square feet. There's just not that many buildings bigger than that. Very few people need 1 million square feet. That's a hyper specialized building. So if you do want bigger, you tend to start looking at portfolios of industrial buildings. But what's nice is you can kind of chop those up in a way that makes sense for your buying power. So that's kind of where we're at there. And, we have plans probably in the next quarter. I think we're going to launch our first fund. So, we've built up a long enough track record, done enough exits, and really, streamline the type of product that we specialize in. So we'll be transitioning over from a deal to deal basis to, kind of building a fund that'll probably hold about 10 to 15 properties. So all exciting, progressions on the space.
Approximately how many deals have you done, and what was like, can you elaborate even, what you can on the best deal so far?
Yeah. So sure. People love talking about their wins, but we've, as an investment group since 2015, when we were founded, I think we bought just shy of about 50 investments. We've gone full cycle on about 17 of those. So we own a few over 30 right now. And one real exciting one, we bought this aerospace tenanted piece of real estate in Mansfield, Texas, just south of Dallas. And it was kind of our bread and butter transaction. They were being acquired, family-owned business. They were being acquired by a private equity backer. Right. And we were buying the real estate at the same time. So it was a simultaneous kind of three-way transaction there. And, we ended up with a private equity backed tenant, brand new 20-year lease, triple net, kind of our bread and butter. Cash flow is great from day one. And one cool way that we can build value, we never underwrite for it because it's sort of out of our control. But in this case, we really saw it was that private equity group was hyper successful at what they sought out to do and grow the tenant, right? And they grew from 15 million a year in sales. 3 years later, they were at 70 million a year. So, literally had dramatically grown this company, which adds value to the real estate, ironically. So now I have a stronger tenant. That means a lower risk of default. So now I can sell my real estate with that tenant attached at a premium to the next buyer. So, and in that process, they actually needed more room, and we were able to develop and add an additional, I think, 30 or 40,000 square feet to the, square footage on the property. Yeah. And so we were able to increase rents and dramatically add value for both them and for us and our investors. So anyway, it was a big win. That deal, I think we exited about a year ago. Held it for about 3, but really just all the check boxes of interesting ways to build value, limited downside from industrial, just consistent cash flow paid out monthly, and those are, in my opinion, all really the best parts of this particular asset class.
The stars aligned for that deal. It sounds like but what I wanted to just kind of go back to is like, so the value of the real estate went up because the tenants, business kind of, it became really even more successful. Like that, again, they're just caught me off guard because it's has nothing even to do with the real estate, but it does in your space. You know what I mean? I have to get my head around that as well.
So quick cap rate lesson. High cap rate typically means more risk. You're going to pay less for the same amount of cash flow. Lower cap rate means lower risk. You're going to pay a little more for the real estate. So, when you go to sell, you want a lower cap rate. And when your strength of credit of your tenant increases, when it gets to be a better tenant, then you're able to sell at a lower cap rate correspondingly. And to use an extreme example, let's say I had, Joe's Hardware Supplies when I bought this building, and then they get bought out by Amazon. And now I have Amazon as a guarantor on my lease. That's about as watertight as you can imagine. So that deal might go from a 6 cap to a 3 cap with an Amazon tenant, and that's really the power of having, a very strong tenant. And, most cases it's not that extreme, but, when you're able to grow your tenant company and improve their financials, or if those financials improve while you own the real estate, it drives value to the building as well.
Hey, what's your opinion on the space? Over the next 5 to 10 years? Mm-hmm.
Yeah, no, great questions. Over the last 12 months, we've seen just a crazy amount of capital in the market, in every segment. Multifamily, industrial is no different. We found, frankly, we're less competitive in central markets. So, the Dallases, the Phoenix, Chicago, those areas where we used to find opportunity. There's just so much institutional capital in there that we just get priced out. So, but the good news is, we're able to, especially with our own in-house credit team, find really a nice pairing, kind of opportunity in the seams. So we'll find secondary locations, outside of, say, 50 or 100,000 population cities in the Midwest, where, you have good quality real estate, strong credit, privately held tenants. And we're able to still find, in our opinion, good opportunity and good yield pairing those two together, for us and our investors.
Okay. Next question is because you're also an investor as well. And I know you started off doing single family homes because of your military buddies. But knowing what you know about, even multifamily and just, triple net leases, industrial space, do you think you would have gone directly, would you start off with single families again first, or would you done it differently?
Probably done it differently. I went single family because that's all I knew. Right. Yeah. I like the commercial space because there's less players in the market, and I think if you invest with the right sponsor who's really demonstrated they have a true skill set in it, I think that still has more value adding potential and more, overall return potential than the single family space. I think the single family space is a little more commoditized and a little more, frankly, based on luck at this point, that your area appreciates. It's really hard to get a good cash flowing asset in the single family space just based on how prices are raised compared to rents. Whereas, comparatively in the commercial space, I think you're still able to find a more blend of skill and luck when it comes to, generating returns.
Yeah, makes sense. I have some final questions for you. First one. So what are you excited about in your business right now?
Yeah, I mentioned that fund. We've been, really working on that for about 2 years now. So super excited to, realize that. And, I think it'll be a nice blend of, maybe taking out the binary risk of a single tenant property by, adding, say, 8 or 10 of them all under a, umbrella fund there, but still able to generate, similar returns from a single, deal by deal basis. So that's probably the biggest move that we're excited about. And, it's just been a long kind of lead up to this transition.
Next question is related because you're also a real estate investor. What has real estate investing done for your life?
Oh, I love it. Honestly, 2 reasons. One, I'm not tied to an office. I'm in San Francisco now, but, in the last 12 months, I've worked from the ski slopes. I've worked from the beach in Puerto Rico. I've worked from Munich, where my wife's from. It allows me the flexibility. We put boots on the ground on our property for due diligence, but by and large, the day-to-day, I'm free to be anywhere. And that opens up my headspace to just be creative, be efficient, just in a way that I couldn't if I was stuck in an office every day.
That's awesome.
And the other piece is, I'm building a residual cash flow. I'd like to see myself in a few years where I work because I want to, but not because I have to, because this investment portfolio is generating my life nugget, if you will. I'm paying my bills. I have discretionary income, and now anything you do beyond is sort of up to you because you want to.
Yep.
And that, to me, that's freedom.
Yep, absolutely. I'm agreeing with you. Any big goals that you're working on this year, either business or even personal?
Yeah, it's supposed to be a 2021 goal, but don't tell anyone. But this year, I'm going to be definitely this year. I'm going to publish my first book. So,
nice.
been working on a while, and more kind of education, but talking about the industrial space, the single tenant market, sale leasebacks. In my opinion, a underrepresented asset class in commercial real estate investing that I feel we have a nice expertise on, and have a lot to share there.
No, absolutely. I'm glad that you're doing that. Like I'm saying, there's just so much in multifamily. There's nothing. I'm excited again, I was excited to bring you on as a guest because I don't know anybody well, I personally don't know anybody that can talk about your niche. Yeah.
Niche
so,
niche, right?
Yeah. Next question. What does success mean to you?
To me, it's just living your life, like pairing work and life today, as opposed to slaving away in an office with this hope that when you turn 60, everything's going to flip a switch and be great. Right. I mean, honestly, like, I think COVID opened a lot of people's eyes. I could get hit by a bus tomorrow. I fly recreationally. Let's face it, my plane could crash in 5 years, right? I don't know. But if I'm able to kind of pair my personal life and my work life from today, and I'm doing it in a way that I enjoy it and I'm good for the people that I work with, I mean, to me, that's my kind of success metric.
Awesome. And what's your superpower? What's contributed to all your?
When I was little, it was because I was tall and I could reach things. Now, I don't know. Now I think I've accumulated a decent amount of life experience, and I would say my superpower. I've been to 112 countries now.
Wow.
From a flying background, from a military side, I think I've accumulated a diversified assortment of life experiences that I can relate to almost everyone on some level. And, something that I couldn't do 10 years ago or 15 years ago, but something I've really worked for to kind of create a sense of roundedness where you can find something in common with anyone you talk with. And that, I would say, that's my superpower.
Very cool. And last question, how can somebody get a hold of you?
That's a little easier. So, you can reach out direct. Check out our website. We've got some great stuff on there. Drop me a line. Love to get feedback on podcasts, talk more, answer questions, or include you in our investment group. You can reach me, Neil Wahlgren. It's Neil, like the astronaut. Neil at magcp.com.
Perfect. Well, thank you, Neil, for joining me on this episode. That's a wrap, folks. I found this, this conversation was like commercial real estate 101. In the industrial space. It was amazing. So to my listeners, thanks again. Thanks for joining and listening in. Reach out to Neil directly if you have any questions for him. Thanks for checking out this episode for the School of Cash Flow. And also remember to leave a podcast review on iTunes, as it helps me attract even more great guests just like Neil. So until next time, live life abundantly.
Thanks for listening to another episode of the School of Cash Flow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.